Paying off your credit card debt is not just good advice. It is mathematically the single best investment available to any human being on Earth. No stock, no fund, no guaranteed bond can legally promise the return that erasing that debt delivers. This is not motivation. This is arithmetic. And arithmetic does not negotiate. At one of Berkshire Hathaway's shareholder meetings, Warren Buffett was asked about debt. His view, in essence, was this: if he personally carried a balance at 18% interest, the only rational move was to pay it off immediately. Before we go further, a word from one mentor to another. If clear thinking like this strengthens your own discipline, subscribing is simply you backing that discipline going forward. And if you already have a guiding rule for your own money, write it in the comments.
In substance, he said that single decision, erasing an 18% debt, was better than any investment idea he has ever had. That is the standard he set. One bill, outranking every stock he has ever recommended. Why would the most successful investor in modern history say that paying a bill beats buying a business? The answer is opportunity cost. Every dollar in your hand can only do one thing at a time. Buffett's logic forces one comparison. First, what could that dollar earn elsewhere? Second, what is your debt already costing you? Once you put those two numbers side by side, the decision makes itself. Look at the comparison itself. For 50 years, the S&P 500, the broadest measure of the American stock market, has returned somewhere between 8 and 11% a year, before adjusting for inflation. But that average return is never promised in any single year. Some years the market hands you 20%. Other years, it takes 30% away.
Risk is the toll you pay to access that average. There is one number in your financial life that never blinks, never adjusts, and never cares what the market is doing on any given day. Your credit card. 20%. Sometimes 40%. Not an average across good years and bad years. A contractual guarantee, charged whether the economy is booming or collapsing around you. Here is the insight almost no one says out loud. Paying off that debt works exactly like a savings account that pays you 20% a year, guaranteed, with no taxes taken out and no risk of loss. Banks would never offer you an account like that. Your debt is forcing you to act as if one already exists, against you, not for you. No legal investment instrument on earth can promise that. Not a government bond, not a blue-chip dividend stock, not even Berkshire Hathaway itself. The market offers you probability. Your debt offers certainty, and the certainty is against you.
Try to do both. Invest and carry high-interest debt at the same time, and the math doesn't average out. It collides. Picture two identical sums of $5,000. One is invested in an index fund, earning 10% a year. The other sits on a credit card, racking up interest at 20% a year, never going down. Over 5 years, the invested $5,000 grows into a respectable profit of roughly $3,000. On paper, a textbook success story. Over the same 5 years, if only the interest is paid each month so the balance never shrinks, that debt quietly drains more than $8,500 from the very same person. Here is the paradox. The investor watches their brokerage balance climb and feels like they are winning. Meanwhile, their actual net worth has fallen by thousands of dollars because the debt's gravity pulls harder than the market's lift.
Banks have a tool built specifically to keep that paradox invisible to you. It is called the minimum payment, usually set at only 3 to 5% of your balance. A payment that small feels manageable, it feels responsible, and it lets a dangerous balance sit there, barely moving, compounding for years. Buffett's broader point
paraphrased, comes down to this. A credit card should never function like a piggy bank, something you crack open the moment cash feels a little short. None of this is personalized financial advice. It is education, drawn directly from the math itself, and a qualified professional should always be consulted before any.
It was built so that you would lose slowly enough never to notice. Look at Ukraine's banking sector through 2025 and into 2026. Retail credit expanded by 12.9% in a single year. That growth produced a banking sector pre-tax profit of 126.8 billion hryvnia. One number, one signal. Privat Bank alone grew its loan portfolio 1.7 times over to 156 billion hryvnia. Its pre-tax profit reached 88 billion hryvnia. Here is the engine room. Banks paid depositors 10.4%. They charged you, the average new borrower, 28.7%. The spread between those two numbers is the business model. Average is a polite word. Some products do not whisper, they shout.
Read that last number again. If you are holding one of these cards, you already know which one. Someone signed that contract. Maybe it was you. You likely never saw the real number until the bill arrived. But the printed rate is not the real trap. The real trap is invisible. It lives inside your skull. Economists call it the pain of paying. Handing over cash triggers a real, measurable discomfort in your brain. Brain scans confirm it. A high price activates the insula, the region tied to disgust and physical pain. A desired product lights up the nucleus accumbens, the seat of reward. That trade-off is happening inside you, right now, every time you decide whether to buy. A credit card severs that wiring. The reward signal stays on. The pain signal goes quiet. And you feel almost nothing. Bidders paying by credit card offered around $41. Same tickets, same game. That gap is the credit card premium, a 64% markup paid for the privilege of feeling nothing. $1 on your card costs your brain something closer to 50 cents of real regret. Now, take the card out of your hand entirely. Replace it with a tap, a phone, a watch. Researchers call the result spendception. Visibility drops to nearly zero. You stop seeing the transaction at all. Wharton researchers found something stranger still. You begin to treat an unused credit limit as if it were your own savings. Not a loan, a possession. Even the typography.
It also strains marriages. Classical theory has an answer for all of it. Attack the highest interest rate first, the avalanche method. Mathematically perfect. So why do most people who try it, and why might you, abandon it before the first debt is even gone? In 2011, 5 researchers, Amar, Ariely, Ayal, Kreider, and Rick, published a study that explained why so many sensible people fail at debt. They gave the failure a name: debt account aversion. Before we go further, a note. Nothing in this video is investment advice. No outcome here is guaranteed for your own finances. This content is for educational purposes only. A qualified advisor can speak directly to your situation. Picture 2 debts. One sits at $600. The other towers at $6,000. Pay $150.
You've moved the needle by 2.5%. Your brain barely notices the second number. This is why the mathematically correct plan so often collapses. The avalanche method says attack the highest interest rate first. The math is sound. The feeling of progress is absent. And feeling, not formula, is what keeps a person paying month after month. So what happens when you stop fighting your own psychology? What happens when you start using it instead? The debt snowball method makes one deliberate trade. It gives up the interest rate advantage to gain something a spreadsheet can't calculate: momentum. The rule is almost insultingly simple. List every debt you owe, from smallest balance to largest. Ignore the interest rate completely. Size is the only variable that matters. Pay the minimum on every debt except one. On the smallest balance, throw every spare dollar you can find.
It rolls forward, stacking onto the next smallest balance. The payment grows. The list shortens. The snowball gathers size as it rolls downhill. Researchers from the Kellogg School and Harvard Business Review tracked what happens when real people use this method against the alternative. Snowball users paid off their debt 15% faster than those using the avalanche method, or no method at all. Completion rates were higher. Fewer people simply gave up. 15% faster by abandoning the math. What does that tell you about where debt is actually won or lost? Before the snowball starts rolling, the plan calls for one thing first: a starter emergency fund of $1,000, set aside and untouched. Researchers writing
$1,000 stands between you and the next flat tire, the next broken appliance, the next small emergency. Without it, that crisis becomes a new charge on a new card. With it, the snowball never has to stop. Build the $1,000 buffer. List every debt, smallest to largest. Pay minimums on all but the smallest. Attack that one with everything extra you have. Roll the payment forward once it's gone. Repeat until the list is empty. But a list on paper is not the same as a habit broken. The final step isn't financial. It's physical. Financial author Dave Ramsey calls it the plastectomy. The name is deliberately surgical. You are removing something from your life, not negotiating with it. Every card, cut. Not hidden in a drawer for emergencies. Cut, so the temptation to swipe no longer exists in your hand.
The card stops existing in any form that lets the pain of paying disappear. Go back to where this started. Warren Buffett looking at an 18% debt, calling it the best investment idea he has. The snowball is simply the discipline that gets a person to act on that idea, one balance at a time, until the number reaches zero. Every account closed is a payment that no longer leaves your hands every month. Every payment that stops is income that returns to you for the first time, with no bank standing between you and it. The debt is gone. The card is gone. What's left is the first